more or less the same. And we actually came on a little bit earlier tonight because, we didn't want to get in the way of the two geniuses that will be debating at 6 p.m. this evening. And instead, you get to see Josh and I debate or answer questions. But you might be watching us on Facebook. You might be watching us on YouTube, wherever you're watching us. We appreciate it. We're thankful for you guys tuning in. Let us know where you're watching from in the comments below. We'll definitely give you a shout out there. And if you have questions, that's why we're here. So leave your questions in the comments and we'll go back and address those and try to provide some clarity for you. And if you like this content, give us a thumbs up, share it with your friends, family, because it helps both of us, accomplish our goals of trying to educate buyers and sellers and make this process a little bit easier to understand. So, Josh and I were talking prior to coming on the air about interest rates, because that seems to be the hot topic for everyone, whether you're buying a house, refinancing, or whatever it is you're doing. Everybody wants to know, where are rates, where are they going, so on and so forth. So when I talked to Josh a moment ago, I kind of posed the idea that this is more or less the first time in history that the Fed has come out and given us kind of, a real date as to when they might consider adjusting the Fed funds rate again. And that's in 2023. So the thought behind that, or at least when I look at it, is that interest rates will likely stay low for another 2 years. You had another take on it, but I'll let you talk about that a little bit. And also maybe update people on where rates are at the moment. And then we'll get into some questions because I see them popping in at the moment. So.
Absolutely. So in terms of mortgage rates, it's less important what the federal funds rate is. And absolutely, that thing's not moving for a couple of years. It was nice of the Fed to come out and announce that. You got to dig a little bit deeper into what they were saying to see what's going to happen with mortgage rates. They did talk specifically that they will continue buying treasuries, which will keep rates lower, primarily at the shorter end of the curve. What they did not say is that they're going to continue buying mortgage-backed securities, that they will continue to buy them at the rate that they are. Back in April and May, they bought $250 billion of mortgage-backed securities a month, which is just an astronomical number. When you look at that number, it's not surprising at all that rates dropped as rapidly as they did. They were pretty much buying every Fannie, Freddie, FHA, VA mortgage-backed security that the markets could throw out there, they were buying. That number is down to about $100 billion a month, which is still an astronomical number. It's only small relative to the $250 billion. If they back away from that, we absolutely can and will see interest rates slide a little bit higher. I think that's likely to happen. But do we have any risk of rates going to 3.5%, 3 3/4, or heaven forbid 4%? I don't think we do. One of the greatest predictors of consumer spending for the middle class is home equity. Home equity is doing very well right now because interest rates are low. There's low supply and there's lots of buyers out there benefiting from lower interest rates. As rates go higher, especially in high cost areas like Southern California, they're more rate sensitive as payments go up. People are buying homes and pushing prices higher because payments are not higher because rates are low. So that's going to put a ceiling on interest rates. But my guess would be that we will see a little bit of inching up at some point here in the fourth quarter into the first part of the year. Now, if that doesn't happen, the Fed keeps buying and rates stay really low, wouldn't shock me. But if I'm a betting person, I'm going to say 2-to-1 odds that they'll inch slightly higher. Now, that being said, what we've seen over the last few weeks is that rates have improved and pretty much almost back to the best levels for most really well-qualified borrowers. Your conventional loans are back into the high 2s. So rates are absurdly good. The biggest thing, and you and I keep talking about this, that I tell all of our clients, take advantage of the rates. People have a misconception of how much rates need to move for it to be worthwhile. There's still a lot of information out there, people saying, hey, you should pay a bunch of points and buy the rate down as low as possible. The numbers never lie. Just get with someone you trust and have them do a thorough analysis. Here's where you're at. Here's an option of a no cost or a 0-point loan. Here's what it looks like if you pay a couple points. Most people, 80-90% of people, when they see that, are going to decide to go with a low or a no cost loan. But some people do like getting those really low note rates. And long way of saying, right now, as many refinances as we and every other mortgage lender have put on the board this year, there's still more people who can and should benefit that have not refinanced than actually have. So we're not in need of any more of them, but it's sort of make hay while the sun shines for us. You do as many refinances as you can, no matter how tired you are, because it's great for your income. Homeowners should take advantage of it also, rather than thinking, hey, rates are absolutely going to go lower. Long term, 3, 4, 5 years out, I do believe that rates will be lower than where they are today, but it's not going to be a straight line, and we're probably to the end of the decrease. High twos is probably what we're going to see as the lows for the current market cycle.
No, understood. And I think there's a misconception out there, because I mean, I see it in videos on YouTube and other places about how refinancing is a bad thing. And there's probably, there's a lot of people out there that think if you refinance, you're going to pay all these costs to do it, and your loan's going to start over, and you're going to have this 30-year term. And the reality is, I mean, you can talk about this in more detail, is loans these days can be structured to whatever you want them to be. And you don't necessarily have to pay a lot of cost. I mean, there's lenders out there doing no-cost loans. Me, for example, perfect example. I was able to lower my payment, pull cash out, and actually get a lower term on my mortgage by refinancing. To me, that made a lot of sense. Now, everybody's not going to have that exact same scenario, but it doesn't hurt to have that conversation. And a lot of people should have it, whether or not they're thinking about doing a refinance now or waiting for rates, to go lower or whatever in the future, just to have that, mindset or idea of what they need to do in order to make that happen.
I've got a really good friend in Florida, super sharp dude. He's an internet marketer and does all the back end stuff, runs numbers 6 ways to Sunday. And we're having a conversation, and I think it's the property, the interest rate's like 3.75, 3.875. He goes, well, I just need to talk to someone, see if you can refer me someone down here. Made a good referral to a buddy, and I said, I can send you the referral. I said, it doesn't matter. If you're at 3.875, it absolutely makes sense to refinance. He goes, well, I don't know how long we're going to be here, so I need to do this calculation. I go, I can tell you this. At a $300,000 loan, a no-cost loan is going to be no worse than 3.25. So if you can go 3.875 to 3.25, do a no-cost loan and do a custom loan term to keep the loan term the same, there's really truly no cost other than the cost of supplying your documentation, signing your loan docs. So there's a little bit of effort, a little bit of sweat equity in that, but there are a ton of people who can and should benefit from doing a new loan that haven't done that. So it's important to know that, yes, there are super low rate, high cost options. There are slightly higher rate, no cost options, and you do not have to start back at your original loan term. When we do our analysis, one of the things we like to give borrowers is a no cost loan with the same loan term. So you can see that's true apples to apples. I'm not paying for anything, and I'm not starting back at 30 years, whether they're at 27 or 25 or 22 years. We're not getting a bunch of savings by starting back at the beginning. And when people see that, it gives you a good baseline. Okay, that's free money. Now, am I willing to pay more to save even more money on a monthly basis? And am I going to be in this home long enough to recoup it? So many of these refinance shops, whether it's the big ones that you see all over TV and radio or a local one that's sending out mailers, they hire a bunch of kids, they throw them into a cubicle, and they tell them to focus on, here's how much you're saving on a monthly basis. Not the best way of looking at it, unless you're looking at all of the options. That may be the best for you, and you may choose to go that route. But when you're not looking at it from all angles, both in terms of losing or giving up a few years of payment on your loan and possibly adding to your loan balance, it's important to look at all angles.
No, absolutely. And so we've got comments coming in. Some people commented and told us that they're watching from Ohio, Pennsylvania, Oregon. So we've got people all over the U.S. at the moment, California as well. Deanna asked a question asking about how we decide on the best lender. So, what I'll say, I'll start this because I have this conversation in talking a lot with clients who are looking to purchase property, and they may already have a lender that they've, decided on or think that they've decided on because they've gotten pre-approved with that person to start the process. And what I tell people is there's more to look at than just the payment that you're getting, the rate that you're getting, the fees that you're getting. You've also got to, I just had this conversation a week ago with a client that actually ended up having a conversation with you. And I said, look, the company that you got pre-approved with was online, which is fine. No harm done there. But Here's the thing is, we're looking to write an offer on your loan tonight. Is that guy in wherever state he's in going to pick up the phone, have a conversation with me so that I can actually get the documentation I need from him in order to submit the offer? One. And secondly, is he going to be able to hold a conversation or have a conversation with the agent on the other side? Because I'm going to need that, whoever it is, to call the agent and, give the qualifications of the buyer to help strengthen our offer. So if your guy can't do that, then you definitely need to have another conversation for one. But you can parlay on that and add your 2 cents as well.
Yeah, the thing that I always like to say is people will often ask, well, should I work with a broker, or should I go to my bank, or should I go to this mortgage company? And what I always lead with when people are asking those questions is you should go to an expert. So how do you know you're working with an expert? You want to know how long they've been in the business. You want to know how much business they do. Hopefully they were referred to you by your realtor, by a friend that's closed a loan with them. Those are not guarantees, but those are your first steps of what you're wanting to do. And then you're going to base it off of your conversation. Like I always say, people want to shop, and I know loan owners are like, oh, I hate them, they're shoppers. Like, the best thing that can happen for me is for you to have 2 other conversations before we talk, because I know the quality of our conversation, the depth that we're going to go into answering your questions, and the things that we're going to go through are going to be different than anyone else. And you're going to walk away from that conversation feeling, hey, that's someone that has my best interest at heart, that asks the right questions, that listens and understands what I'm wanting to accomplish here. And that's what you're looking for when you want an expert. So what I tell everyone is, 25 years ago, you would see someone that would get a loan that was just atrocious. And you're like, how in the world does someone pay this much? Well, it was hard to get information then. Now, because information is so readily available, people have an idea of what ballpark interest rates and fees should look like, that most lenders that you talk to should be in a pretty narrow range where it shouldn't be a rate and fee conversation. I'll tell anyone that will listen, we're a broker. We have low rates, low fees. If you polled 100 lenders, we're going to be right there closest to the cheapest. I'm not going to be the cheapest. There's going to be a handful, 3, 4, 5 that are lower, but there's no one that has the combination of expertise and low cost, low price. So that's what you're looking for. Someone that is competitive, that has good fees, good rates, but that has the ability to answer your questions, get you the information that you need, and make you comfortable. It's a stressful process. You want to make sure that they've got your ducks in a row. You don't know what to look out for in the transaction. So you want someone that is looking out for all of the problems that could come up, that's keeping you informed, that's keeping you educated, so that you have a comfort level throughout that process, so that the stress isn't ratcheted up. So by all means, Deanna, I would say talk to a couple of people, base it off of, if hopefully they're all going to be in a similar price range. And I would never advise someone to go with the cheapest. I would advise someone to go with the best. And if the best is significantly higher priced, ask the question. Say, hey, I talked to 3 lenders. I like you the best. Your fees were the highest of the 3. Is there anything we can do to meet in the middle and get those numbers a little bit better? So that would be the biggest mistake that I see people making, is just going purely based off of price, or even purely based off of rate. I have people all the time who say, oh, I got a much better rate than that. Okay, well, cool. Send over the loan estimate. Let's take a look at it. The loan estimate lists everything out. Yeah, that's a better rate than what I offered you. You're also paying $6,500 for it. If we did that, you would be lower. So just be open with everyone. I have no problem talking to a shopper. I have no problem doing a side-by-side analysis. My job is to keep you informed and educated so that you can make the best decisions. And if I do that, I feel like 9 times out of 10, that decision is going to be me. So in a long way, that's what I think you should be looking for when you're looking for a lender.
No, that was awesome. So we got Natalie saying signed a contract for a new home, projecting to close until late January. You talked about interest rates in January, so I'm not going to dive into that again.
Let's just cover it real quick. The only thing that's important there is anything longer than a 60-day lock is going to be a little bit expensive. So other things being equal, unless we were sitting here saying, hey, rates are going to go up, lock now, try and get within 60 days of your closing date. And if rates are going up, then you may want to consider locking then. Even though I think rates are going to trend a little bit higher, I don't think it's enough of a movement that I would be worried about them running higher in January. Keep an eye on it. Watch the 10-year Treasury. Keep in contact with your lender and think about locking it when you get within 60 days of closing.
All right. So D-Boy Trucker is saying, what should I be expecting on closing day? I close escrow in October with an FHA loan. So I'm assuming he's talking about rates on that question. If not, you can clarify in the comments there.
Well, one of the things expecting on closing day in California, we don't have we're an escrow state, so you will sign your loan documents a couple days before we close, maybe a day before. In other states, you go to the closing table, sit down, the seller is even there, and you're signing your loan documents. You bring in your funds to close. Everything happens there at the closing table. So that could be very specific to the state that you're in and how they close, but in general, the closing day should be a non-event. One of the things that the government did after the last meltdown is they created something called a closing disclosure. So you get your initial estimate. It used to be called a good faith estimate. Now it's a loan estimate. And that locks in a lot of your charges. Some of them can't change at all. Some of them can only vary up to 10%. But at least 3 days prior to closing, you have to get your closing disclosure and be able to review it. That's going to show your interest rate. It's going to show your monthly payment. It's going to show how much you need to bring to the closing table. So if there's any questions, hopefully those are matching exactly what your lender told you throughout the process. But if any questions, any worries or concerns, you can address that 3 days before you go into closing.
No, there you go. So we've got Nicole asking requirements for reserves. She's doing a conventional loan in California, looking to rent her current residence and buy another primary. She's asking how many months reserve she needs.
With it being another primary, you should be okay. You may need a couple of months on the departing residence if you're going to be using rents there. A lot of times it comes down to it's determined by desktop underwriter or loan product advisor. Those are Fannie Mae and Freddie Mac's automated systems. They're usually pretty minimal, but your loan originator can go through that with you when you're setting up the loan application and tell you exactly what you're going to need.
All right. Freddie is asking any point fees for FHA 30-year loans. Was told by a lender there was a 1 point fee because it's so busy. That's all lenders were charging, a point fee.
Yeah, the biggest thing I would say to that is run from that person as fast as you can. They're just looking for an excuse to charge fees. So yeah, we're all very busy. I'm not charging any more than I was charging last year. I mean, it's I guess you could do that and say, hey, we have a limited capacity and we'll increase our rates or our fees. But I don't know anyone that's doing it. If anything, it's a super competitive market right now, and everyone wants to have as sharp a pencil as possible. So the only thing I draw from that is don't work with that lender. Make a couple of other calls. You'll find some that are absolutely okay with doing 0 point FHA loans.
All right. So Serini, I have decided to build a home we built in 5 to 6 months. Is it worth to lock mortgage rates now?
The easiest way to answer that is to ask your lender, what would it be if I was locking today for 30 days? And if you offer a 90-day, 120-day, 180-day lock, what's the difference? What does it look like? The only reason you would ever take the longer lock or lock now is if you believe strongly that rates were going to be higher 6 months from now. I do believe they might be higher, but I don't think they're going to be appreciably higher. So you're probably better off letting the rate float. But if they tell you, hey, we'll lock it in for 6 months at today's rate, the same rate we would do for a 30-day, might not be any harm in doing that. You got to go through it with the lender and have them tell you their options.
All right. So El Sue, he's in California. AmWest is his lender. It's not a government loan. He hasn't made payments for 4 months. Is he in trouble? Can they take my house? So I guess the question would be, did you file for forbearance? Actually, he comes down and says it again. AmWest advised that I can be in forbearance only for 3 months. So I don't know. Did you take forbearance initially? That's the first question. If you didn't, you definitely should. And at this point, nothing can happen. They can't take your house. There's a moratorium at the moment, at least through the end of the year, with regards to foreclosures, evictions, all of that good stuff. So nothing's going to happen at least until the end of the year. And at the moment, there's an additional stimulus package on the table between the Senate and the House, and we don't know which direction that's going to go. And I haven't read a lot of detail on it, so I can't tell you if there's something in there that even talks about foreclosures or evictions. But last time they did add something in there, so there could be additional stimulus that pertains to that as well. So I think for the foreseeable future, you're good. Josh, anything to add on that?
Well, he threw in another question there. Can I do a refinancing? You can refinance out of forbearance. A couple things. You either need to bring it current, which it doesn't sound like you have the ability to do right now, or make 3 on-time payments. I have a couple of clients right now that took the forbearance because they just didn't know how it was going to shake out. And then they made their July, August, and now September payments, and we're going to loan docs right now. And you can bring the balance that's due current with the refinance. So we have a couple of those going. So refinancing may be an option, but you would probably need to either bring it current all in one lump sum or make 3 on-time payments before you're able to do that.
All right. So that was that. Most of the other questions here have been addressed at the moment that I see. So I will. So, one thing I'll add here is, so today we got consumer confidence numbers, right? So way better than expected, and with that, a lot of people keep asking about the housing market. What's going to happen to the housing market? Whatever. And so while Josh nor I have a crystal ball, what I will say is that nothing, the market's probably going to look very similar to what it looks like now for quite some time, at least for the next 6 months or so. I can't see much changing in that time frame that's really going to have an impact on the market. The biggest driver at the moment, and this is really affecting us here in Southern California and more so in Huntington Beach and Orange County, is that our supply is very, very low. I mean, Josh and I were talking prior to coming on this call, and I think there's a national some report came out. You can clarify about, as a whole, as a nation, I think we're sitting at somewhere around a 3-month average for inventory, which is well below where we should be with regards, or 90 days, you said.
Yeah, just a hair over 91 days, and that's just nuts to think that nationwide you'll see a hot market. The Bay Area was probably the best one around 2000 when the tech market's going gangbusters and everyone's buying houses. You'll see a regional area where the economy is doing really well, but nationwide, 91 days, that's nuts. I've seen it in a pocket of the country before, but not nationwide. So it's very interesting, but it's not unexpected. From the standpoint, rates are really low. Affordability is really high. And whenever we say that, people say to me, no, I live in LA and it's not affordable. It may not be affordable to you, but that's not what matters when we talk about affordability. Is it affordable to enough people that the demand for buying homes outpaces the supply? And that's what we're seeing throughout the country. The bigger issue that we have, people always want to point to, well, we have these people that are in forbearance and we have foreclosure moratoriums. Those are going to go away eventually and these people are in trouble. What no one wants to acknowledge, we have the millennial generation coming into prime home buying age, biggest generation since the baby boomers, and they are buying a lot of homes, and we already have a lack of supply. At a minimum, we could come back into a more balanced market, which would be better for everyone.
Right.
But it's been a pretty stable market. The Case-Shiller numbers came out today saying year over year, a little under 5% home price appreciation. That's a reasonable number for as all of the other strong factors that we have going. I would be scared if we were seeing 10 or 11% year over year appreciation. That's not sustainable, but 3, 4, 5% gains can go on for quite some time. Is it likely to moderate? Yeah, but there's nothing we're seeing here that's problematic.
No, absolutely. And what I'll say, as a real estate agent, for one, I benefit from low inventory, high buyer demand, low interest rates. But I can tell you, as somebody that's been doing this for a long time, I would like to see a lot more property on the market, because my job is very difficult. As somebody that knows what they're doing, writing very strong offers, we're still having a hard time getting offers accepted, with well-qualified buyers. I mean, I've written 3 offers in the past 5 days, one at over $1.5 million, one over 900,000, and one over 8 something. And all 3, and I have a buyer at the moment that wants to put in an offer over $1 million. And all of these properties had 5, 6 offers, and the one that wants to write an offer has 5 or 6 offers, and they're not going to be submitting them, or making a decision for another 4 or 5 days. So by that time, there's probably going to be 10 or 15 offers on this thing. So that's what we're dealing with at the moment. And inventory would be a very good thing. So, inventory only means that it doesn't mean that the prices drop significantly. It just means more buyers can get into property without having to make multiple offer situations. It doesn't mean that properties are going to drop in value. It just makes my job a little bit easier. So,
and Jeb, all of those buyers are extremely well qualified. That when their offer comes over, not a little bit, like extremely well qualified. And if we're lucky, we'll get 1 out of 3 of those accepted with even the best qualified borrower. So it's a tough market. It's not good for anyone other than someone with a listing to sell, whether it's a seller or an agent, because that job is really easy. It's just it's like being the only guy at a party going, "Hey, this is wonderful. The girls only have me to pick from." It's really what it is. Like that, being a seller is a wonderful thing right now. Being a buyer, not so much fun.
No, absolutely. So we're going to keep this probably another 3 minutes or so, guys, just because I know a lot of you are just chomping at the bit to watch that presidential debate, and so Josh and I don't want to interfere with that. So a couple people asking for information. We'll provide that here in just a moment. Let's see here.
Well, Srini had a follow-up there saying that her lender said it can be locked for 8 months with a 1% fee. And if rates went lower, you could float down one time. I wouldn't do that. That's essentially the 1 point cost is the equivalent to rates rising 0.25%. I would be stunned if rates rise 0.25% in the next 6 months. I wouldn't pay a fee up front to lock. If you're super conservative, it's not the worst terms for a long extended lock. So if it makes you feel better and sleep well at night and not stressed throughout the process, it wouldn't be the worst thing. If it were me, I wouldn't do it.
Got it. I'm going to come down here and talk to El Su again. So we were talking a moment ago, if you missed that point about forbearance, he was behind 4 payments. He said his lender could get him, he could do forbearance for 3 months. What I would say is have the conversation with your lender. This is like first and foremost. People get behind on their payments and then they shut down, don't want to talk, don't want to have that conversation for whatever reason, whether it's embarrassment or just think that they can't be helped. And what I can tell you is the best advice I can give you or anyone else that's in that position is call your lender. Tell them, your situation, that you're not in a position to make your payments and that you need help. Most of these lenders, if it's a federally backed lender, they have to give you 12 months. There's no exceptions. They have to give you up to 12 months. They might not start with that. They might start with 6 or 3 or what have you, but they have to give you up to 12. If it's a non-federally backed lender, they don't necessarily have to give anything to you. But what I will say is they don't want the press of not helping out, and that's the reality. So, have that conversation. And if you're willing to have it, chances are you're going to get more with that. And as far as it being reported to your credit report, if you're in forbearance, then it can't negatively affect you. But if you haven't filed for forbearance, then if you have lates, then yeah, that could come back to hurt you. But what I would suggest is calling your lender and having that conversation. Josh, anything there?
No, keep the lines of communication open is 1,000% the right answer.
No, absolutely. All right. So, again, there's a debate going on tonight. Josh and I, if you're watching this after the fact and you still have questions, do me a favor, comment below. We'll go back and address those or use them for our next live. We try to do these once a week, but if there's not a lot of change in the market or not a lot of questions to address, we keeping them every other week. So, I encourage you, if you have questions, put them below. I mean, that's what creates us coming back and keeps us coming back, if you will. So, and if you like the content and you haven't already, like it. Again, it helps more people see it. But Josh, a couple of people asked for your information if you want to throw it up there so that they can contact you directly. So that's Josh's information. We've encouraged you guys over, several of these. If you are refinancing, you're out of state, you're looking to buy a home out of state, you need a good lender, you need a good real estate agent, reach out. Happy to make that referral. As somebody that doesn't do loans, I get no benefit of referring you to a lender other than knowing that you're in good hands. And again, that's part of the reason that Josh and I do this is to help educate, because the more educated the consumer is, the easier our job is, and everybody benefits from that. So anything to add there, Josh?
No, other than as I always say, if you just wade out into the sea on your own, trying to find a realtor or a lender, there's a good chance you're going to get in the hands of someone that, if not outright incompetent, just isn't really great at their job. There are plenty of really good lenders and realtors, but they are the exception rather than the rule. So anytime we can help you guys connect, we've got a great network of both realtors and lenders around the country, and would love to help you.
Awesome. We appreciate you guys taking the time to watch. Again, leave comments if you have them, and we'll see you again